Hey, I'm Ryan O'Connell, and in this video, we're going to be doing a deep dive into the topic of investor perspectives, fees, and performance measurement. You can see this LP right here. This stands for a limited partner as opposed to the general partner. So in the next slide, I'm going to dive a little bit more into what that means if you're not already familiar. So the learning outcome statement for this video is to discuss how private investment firms align their interests with those of their investors. So we need to calculate, so we know there will be some formulas based on this keyword, interpret, discuss private market fund performance from an investor perspective, including management fees and carried interest. So a lot of this video is going to focus on the difference between the general partner or the GP and the limited partner or the LP. So the general partner is really the person who's managing the fund, and they're going to take home the biggest paycheck generally. And the limited partner is really just the investor who gave their cash to the general partner to manage their cash on their behalf. So their interests need to be aligned in a certain number of ways, and we're going to walk through those now. Let's dive into some of these fee structures. So there's management fees, which are calculated as a percentage of committed capital, typically 1 to 2%. So these will happen no matter what. Doesn't matter of the performance. This general partner will collect 1 to 2% of the overall investment as a part of these management fees. Now there's a performance incentive to encourage the general partner to perform well, which is this idea of this carried interest, which is typically 15% to 20%, and it is applied on returns above a hurdle rate or a hard hurdle rate. So we'll distinguish between hard and soft hurdles. So for the hard hurdle rate, it would say, let's say there's a hard hurdle rate of 10% returns. So if this manager in 1 year actually gets 15% returns, that means 5% of the returns were above this hurdle rate, and they're going to take, let's say this carried interest is 20%. So they'll take 20% of that 5%. So they'll earn themselves an extra 1% for that year. That's basically how this hard hurdle rate works. Now let's look at a few of these different clauses and provisions that can be added. So one is a catch-up clause. The entire return is subject to incentive fee once the soft hurdle rate is exceeded. So this catch-up clause, it benefits the general partner. So let's say if a general partner has 3 bad years in a row, they get 0% in year 1, then they get 0% in year 2, and then the next year they get 15%. So they wouldn't have exceeded their soft hurdle rate in year 1. They wouldn't have exceeded their soft hurdle rate in year 2. But now in year 3, they're going to get an even larger bonus because after they pass that 10% here and get the 15%, they're going to make up for the fees that they missed out on these previous 2 years. So they could almost have like triple the investment they get past the hurdle rate because they're making up for lost time. Now, another provision or clause is a high watermark. The general partner can't levy incentive fees until